Hello and welcome to my YouTube channel called Economic Analysis, where we will be looking at different areas of the economy. In this video we will be looking at credit and looking at the banking sector and why credit does not flow naturally to developing countries. Also we'll be looking at how banking expansion to rural areas can reduce poverty. To understand credit markets better, we need to look at the banking sector, and the banking sector is not a charity. Banks want profits, and they will only invest if they believe that they can get a return on their investment. The higher the risk, the higher the interest rate will be to offset that risk. And that's why the interest rates are so high in developing countries. They are often from 40 to 150%. Lucas 1990 did a study on that. So that means that small investments lead to high return. And that should mean that rich investors should be happy to invest in developing countries. And in addition, the law of diminishing returns to capital should mean that capital would flow naturally to developing countries. So why does that not happen? First, it has to do with transaction costs, and it's more costly to fund small amounts. Alem 1990 estimated that the marginal cost of lending is at 48.1%. But still, that does not explain the lack of credit giving the higher returns to capital. The problem here is asymmetrical information. So the banks don't know if the borrower will be truthful. They have incomplete information. The best example of this is Akerlof's market for lemons. So basically what the theory says is that buyers don't know if the car is good or not. So good cars will not get the true value, and they will not be sold. And the bad cars, i.e. the lemons, will get a higher average price. So in other words, both seller and buyers lose out, and it's a market failure. And that same principle applies here, as banks have asymmetrical information. So two features are at play here, and those are an inability to pay or involuntary default, because it's often difficult to monitor what is being done with a loan. The loan could be for productive reasons, but it could also be for other needs that cannot be easily transformed into monetary repayment. Voluntary default is another feature, which is basically where the borrower can repay the loan, but does not find it in his interest to do so. This is mostly in countries with weak legal systems of loan enforcement, which is often in developing countries. But people and businesses in developing countries need capital, and there are three forms of capital. So fixed capital is buying new machines or factories or doing an expansion of the company, requiring fixed capital. You also have working capital, which is basically credit required for ongoing production activity. And lastly, you have consumption credit, which is basically if your costs go up suddenly. It could be a poor crop or a sudden fall in the price of wheat, for example, and you need to have a loan and additional credit. Although fixed capital is of great importance in determining the overall growth of the economy, working capital and consumption credit are fundamental to our understanding of how an economy supports its poor and disadvantage. Most prevalent in the case of agriculture and small and micro enterprises involved in manufacturing, for example. Let's take agriculture. The seasonality of agriculture production and the low incomes of those who live and work in the rural sector heightens the importance of working capital in production. At the beginning of the crop cycle, a peasant has a considerable need for working capital. He needs money to buy seeds, fertilizers, pesticides, and so on. And when you add seasonality to production activity, consumption credit becomes important. An individual's harvest might fail, which causes immense temporary hardship that can only be alleviated through loans. So it is important to have banks give credit so investments can be made and economic growth can occur. But credit is also provided by rich businessmen in rural areas, and many credit relationships take time to build up. Typically, a rural moneylender serves a fixed clientele whose members he lends to on a repeated basis. Repeated lending, a phenomenon in which a moneylender loans money to individuals he has lent to before. So the rural credit market has a tendency towards segmentation. Another problem with the rural credit market is informational constraints, which basically means that there is a lack of information regarding the use of which a loan will be put, and there's also a lack of information regarding the repayment decision. You have to remember that most of these moneylenders are wealthy landlords, shopkeepers, or traders dealing in the marketing of crops. Given a segmented market, landlords tend to give credit mostly to tenants or farm workers. But can moneylenders and banks reduce poverty in rural areas by giving credit to poor people? Well, a journal article by Burgess and Ponte 2005 looked at this very issue. And this paper builds on the belief that governments can use public policy to alleviate financing constraints, and thereby encourage development and reduce poverty. This brilliant idea led to the widespread implementation of state-led rural credit and savings schemes in low-income countries in the post-colonial period. In most cases, this was accomplished through government oversight of the banking sector, often aided by government ownership of banks. Many believe, however, that formal subsidized credit was ineffective in reaching the poor, and may even have undermined rural development and increased rural poverty. This is due to the risk of elite capture, taking advantage of informal markets on which the poor depend. Banks favor opening branches in richer areas, while state-led bank branch expansion programs tend to target poorer areas. In India, they tried to implement a program to get banks in rural locations. This was a large program, it was quite comprehensive, and this program in India is the largest branch expansion program undertaken by any single country. The Indian government nationalized banks in 1969, bringing the 14 largest commercial banks under the control of the Indian Central Bank, and ran this program until the 1990s, aiming to improve the access of the rural poor to formal credit and saving opportunities. Between 1969 and 1990, about 30,000 bank branches were opened in rural locations. The stated aim was to open bank branches in many populous rural areas and locations. The Indian Central Bank announced a new branch licensing policy in 1977. It mandated that to obtain a license for a branch opening in a location with one or more branches, a bank must open branches in 4 eligible unbanked locations. This was effective as a rural bank expansion was relatively higher in financially less developed states after the introduction. Between 1969 and 1990, rural lending rates were kept below urban lending rates, with the opposite being true of saving rates. After bank nationalizations, the central bank also mandated that banks' lending portfolios meet lending targets with respect to priority sectors. These included loans to small businesses and small-scale entrepreneurs and to agriculture. And to ensure that the banks did not concentrate their lending in urban areas, the central bank required that every bank branch maintain a credit deposit ratio of 60% within its geographical area of operation. So to find this link effect between banks opening branches in rural areas and it reducing poverty, they use this equation, this OLS regression, to estimate it. And the paper uses state-level panel data on the number of bank branches, rural credit, and saving shares, and poverty outcomes to identify whether the branch expansion program affected rural poverty. So basically what you see in the equation here is you see the rural headcount ratio, you see the state fixed effect, you see the year fixed effect, and you see the poverty impact of rural branch expansion. And you see the cumulative branch openings in rural unbanked locations per capita. And then you also have the error term. Here you see a graph that shows the relationship between branch openings and initial financial development. Basically what this graph shows is that there were more branch openings in rural unbanked locations that had greater initial financial development between 1961 and 1977, which is the positive trend you see there in the coefficient going upwards. The trend is reversed in 1977. Financially less developed states witnessed higher growth of branch openings in rural unbanked locations. After 1990, branch expansion into rural unbanked location ends, as you can see on the graph here when the line goes horizontal. And then you can see a table here in the paper by Birch and Panda 2005, where they show bank branch expansion and poverty to see if it's reduced. So basically what you see here in column 1 is that column 1 demonstrates a strong inverse relationship between rural headcount ratio and the opening of branches in rural unbanked locations. A 1 point increase in branch openings in rural unbanked location reduces the headcount ratio by 4.71. Rural poverty reduction was more rapid in more financially developed states before 1977 and after 1999. A 1 point increase in initial financial development reduced rural poverty by an additional 0.77 points annually. Between 1977 to 1999, a 1 point decrease in financial development saw rural poverty reduced by an additional 0.38 points annually. Between 1977 and 1999, wages for agriculture laborers, a marker of the welfare of the poorest group in the countryside, also increased more rapidly in less developed states. The reverse is true after 1990. Factory wages, located mainly in urban areas, shows no relationship with states' initial financial development. And here we see another table, which basically shows that a coefficient on branch openings in rural unbanked locations is positive and significant at 2.09. This is consistent with the program-based explanation wherein poorer, financially less developed states attracted more rural branches between 1977 and 1999. A 1 point increase in per capita branch openings in rural unbanked locations is associated with a 4.74% reduction in rural poverty. Rural branch expansion in India can explain a 17% reduction in the headcount ratio. In contrast, rural branch expansion did not affect urban poverty. And here we see another table that they have in the paper, and it basically shows the increases in rural credit and savings shares reduce rural poverty. A 1 percentage point increase in the share of credit dispersed by rural branches reduces rural poverty by 1.52 percentage points. Similarly, a 1 point increase in the share of savings held by rural banks reduces poverty by 2.22 percentage points. We see that urban poverty is unaffected by increase in rural credit and savings shares. So basically, to conclude, this paper, a journal article by Birch and Panta 2005, basically finds that the branch expansion in the rural unbanked locations in India significantly reduced rural poverty. It showed that this effect was at least partially mediated through increased deposit mobilization and credit disbursement by banks in rural areas. In contrast, the rural branch expansion program left urban poverty outcomes unaffected. Between 1977 and 1999, the 1-to-4 licensing policy caused commercial banks to open more bank branches in less financially developed states and proved very successful in reducing rural poverty. So basically, the program to get banks in the rural areas reduced poverty, so giving credit to poor people has shown, as this paper, that it has positive effects on poverty. But basically that is all I have for this video. I hope you enjoyed the video, and if you liked the video, please press the like button and subscribe if you enjoy the content, and I wish you all the best.